All right, guys. So tonight we start with a beautiful standard. You guys are going to love this standard. And this is light free so because it's a beautiful standard. One of those standards where you cannot just forget what you've learned. It's a beautiful standard, one that the examiner likes a lot, one that is more like to pop up in your exam. So it's a standard you can't afford to forget. All right, guys. So tonight we have the joy of looking at the following. We have the joy of looking at Ifrs number 15. Now, Ifrs number 15 is such a beautiful standard, guys. It's a standard that tells us about revenue from contracts with customers. Revenue from contracts with customers. So why on earth, guys, are we going to be spending time looking at revenue from contracts with customers? So here's something I would like you to know. I would like you to remember this very well because on every standard, there are a few things that you must know. It's always important, guys, to know what the standard is about. Always important to know what the standard is about. You cannot do better if you don't know what the standard is about. So the standard, of course, is about revenue from contracts with customers. But here's what you need to remember. You need to remember your job. You need to remember your aim. What is your aim? What is your job on this particular standard? What are you expected to do by the examiner? What are you expected to do by the examiner? So here's what you're expected to do by the examiner. So know this one, extremely important. Extremely important. All right, that's fantastic there. We have a comment. So guys, the examiner expects you to know the following on this standard. Ifrs number 15. Notice, this is your aim, you're the student, not the other thing. This is your aim. This is what you must know. So what you must know before that fateful Monday morning is you should be able, as a student who is serious, who wants to pass advanced reporting or financial reporting, you must be able to discuss and apply the criteria that must be met before an entity can apply the revenue recognition model. Now, you and me know, guys, that the revenue recognition model is a 5-step model. So, before you can go on a rampage in the exam of telling the examiner that this model should be used, you must be able to discuss and apply certain criteria that must be met. So you don't use that model up until certain criteria have been satisfied. It's important for you to know that. So somebody may be asking, but what kind of criteria is that even? So let me take you back to this criteria here. So the criteria that must be satisfied, guys. Number one, we have the following. Number one, we have the following. So the following criteria would be nice for you to know before you talk about those 5 steps. Know these 4 steps first. Yeah. So number one, the examiner requires you, the student, to know these ones. The examiner wants you to know that before you can recommend in the exam that now this company should be able to use the revenue recognition model, the examiner requires that you know the following criteria. Number one, you must know that both parties have enforceable rights. So before you decide, or before you advise in the exam, confirm on the document whether both parties in this contract you are dealing with have enforceable rights. It's important for both parties to have enforceable rights. What that means, it means that the contract is approved by the law. So number two, you must also remember that contract must be approved. By contract approved, here the examiner means that it's not a contract where you can just wake up and say, hey guys, I'm terminating. You can't just do that. So before you advise, confirm these things have been satisfied. Contract is approved. Number three, you must also check whether this company and the other company have agreed on certain payment terms. Have payment terms been agreed? If the answer is yes, then go on to number four. You may want to go also number 4 and also check whether there is commercial substance to the contract. The examiner will tell you something in the exam. And if whatever the examiner has told you, there's no commercial substance, then don't even think of using the revenue recognition model, because there must be commercial substance to the contract. It can't be barter system where Kutemba comes and tells me, hey, Shadwick, I'm going to give you my car, give me your car, we exchange, or give me your house. No, we won't do that. We need some commercial substance to the contract. So that is your job to check in the scenario if these things have been satisfied. Apart from that, the examiner also wants you to also be able to check that the customer, that's step number 5 now, that you are dealing with a customer who can and probably intends to pay. So we don't want storytellers here. The examiner says, you know what? I don't need storytellers. I need customers who are able to pay. So when you are signing a contract under revenue, you must ensure it's a customer who is able and probably. Now that word there, probably, the word probably, guys, means more than 50% chance that this client of yours is able to pay, is capable of paying, intends to pay. More than 50% chance, is interested and is willing to pay. Apart from that one, guys, you must remember this. Now remember what we said. Why then are you supposed to check all these 5 criteria before you think of using the 5-step revenue model? Why should you ensure these 5 things are present? For what? Why? So we have that question, but why? Now I'm going to tell you why, because I'm such a very nice man. So I'll tell you why, guys. Why? It's because, guys, Ifrs number 15 wants entities to recognize revenue which reflects a consideration to which the entity is entitled in an exchange of goods and or services. So the standard says, you know what, Kutemba, I do like you a lot, but I don't want you to recognize money which you've not yet worked for. That's not how this is going to work. The standard says if Kutemba PLC is going to recognize money in their statements, it must be monies which reflect a consideration to which they're entitled to. It must be money which Kutemba has actually worked for, has actually satisfied what we call a performance obligation. So if it means if I go to Kutemba right now, I give her a 50,000 down payment for consultant services, she should not recognize that 50,000 in her books because she has not yet worked for that money. It's a down payment. She will only be able to recognize the money once she satisfies the performance obligation, or she does that gradually. Very, very important. That is what this standard is trying to achieve. So they say, so before you think of doing that, make sure these criteria are present. We don't want companies to overstate their revenues in their statements. We want them to show monies which we know they are entitled. Period. Are you guys okay with that? Let me know what you think, guys. Are you okay with that? Am I clear enough? Somebody say something, guys. Am I clear enough? Are you able to hear me? Hello, guys. Can you hear me clearly? Let me not make a text message or something like that. Oh, somebody says we are good. Okay, good. Okay, good. Mr. Aiko says you can hear me. That is good. All right, guys. So let's go. Please feel free to type in your comments, your questions, and anything like that. Okay, Mwamba says yes. Fantastic. All right, guys. So now let's continue to business. Okay. Yeah, okay. Mwamba says she can hear me as well. That is good. All right, guys. So now, remember what we were just from saying. We are from saying this, the main idea of having the standard Ifrs number 15, the aim of the standard. No, there are 2 aims here. There's the aim of you, the student, and then there's the aim of the standard. Now, let's differentiate the two. The aim of the standard is to make sure that companies only recognize revenues which reflect the constitution to which they are entitled in exchange of what of goods and services. Somebody mute yourself, please. We're getting some feedback. All right. Now, your aim as a student, notice, is different. Your aim is to make sure that you do the following. Look, there are two aims. The aim of your students, you the student, is this one. You should be able to discuss and apply the criteria that must be met before the entity can apply the revenue recognition model. That is your aim as a student. Now, the aim of the standard, on the other hand, is to ensure that the following happens. This is the aim of the standard: to allow entities on to recognize revenues which reflect the constituent which they are entitled to in an exchange of goods and services. That is the aim of the standard. Extremely important for you to understand the difference. So now, how does Ifrs number 15 achieve this aim? How does it achieve this obligation? Those guys who are watching us live, please take a second to share this video, please. So what we have, guys, is this one. How does Ifrs 15 achieve its aim? How does it ensure that aim is achieved? Well, we have the following 5 steps that have been introduced. But as we look at these 5 steps, guys, I want you to remember something. I want you to remember one thing in your mind. When and how much to recognize in every transaction. It's important to know how much to recognize, because the examiner will tell you a story about this client and how they gave you a down payment and things like that. So you have to know, should you recognize every amount that you've been given, or how much is there for you to recognize? It's extremely important to know that. Very, very important. All right, so let's go and see how much to recognize. So we have the 5-step model below that is going to help us. We have this 5-step model. Step number 1. The standard Ifrs number 15 has given us a 5-criteria model which helps us to recognize revenues. And step number 1 says the following. It says, before you begin to recognize monies, it's important to identify the contract with customers. So, in the exam, there should be a contract with customers. Don't just recognize anything because you feel like recognizing. No, make sure there's a contract. Okay, is that a contract? And when we say contract, remember step number 1. How do you know there's a contract? You have to go back to your M. How do you know there's a contract? Go back to M. Remember what we said? Your M is to do what? Is to discuss and apply the criteria that must be met. So there are still criteria that must be met for a contract to exist. And those criteria are here. So when you check that these criteria are present, both parties have got enforceable rights. Contract approved. Have you seen? Payment terms agreed. Commercial substance to contract. Customer can and probably intends to pay. Then you know there's a contract here because all these things have been satisfied. That's how you know. So step number 1 of the revenue recognition model is your aim, making sure a contract actually exists before you begin to waste your time. Extremely, extremely important. All right, guys. So let's go. Let's go to something else then. So that is step number 1. So step number 1, identify the contract. How do you identify? Contracts must be approved. It is signed by both parties. Enforceable rights are present in the contracts. You can sue, or somebody can sue you, can be sued. There's commercial substance. It is not barter system. There are figures stated somewhere in the contract. The customer, will probably be able to pay. It's not a client who can't pay. Somebody who's financially stable is able to pay you the amount that you need. So it's important for you to remember that. All right. Is there anything else? Yes, there is something else. We now go to step number 2. So step number 2 says, hey guys, identify what is called the separate performance obligation. So guys, now when we say separate performance obligation, what we mean is that these will be goods or services promised to a customer. Now, not something here, guys. Goods or services need to be distinct in order for you to create a separate performance obligation. So step number one is the contract. Step number two, identify the separate performance obligation. Why? You are going to appreciate this point, especially when we get to leases, because there's what we call components of a lease. Part of the item is for the lease, part of the item is not for the lease, is for something else. So when we get to the lease, maybe you will appreciate this even better. Yeah. So now I have a question for all of you guys. Those of you from Facebook, those of you from class. Guys, what do you think of this word? See, I put in capital letters. Goods or services need to be distinct. What is that? What does it mean to be distinct, guys? It says goods or services need to be distinct in order for you to create a what? A separate performance obligation. What do you think, guys? Let me know what you think. Let me see some comments come through. What do we mean by goods or services need to be distinct? What do you think, guys? Let's hear from you. Yes, guys, what do you think? Guys from Facebook, please participate. Guys from class, please let me know what you think. What do you think? Yes, guys, distinct, what is that? Yes, guys. And to see some comments. What do you think? When we say goods or services must be distinct, what do we mean? Yes, guys. Okay. Guys, distinct, what do we mean? Yes, guys. Guys from Facebook, let me see some comments come through. All right, so we have some comments coming through. Some people are saying, Mr. Wycliffe says goods or service must be identified. Okay, distinct must be identified. Okay, thank you so much. That was Nyafwendi Kaponda. Thank you so much, Nyafwendi. Mr. Wycliffe says differentiating the goods and services. Very good. I think that's the correct answer. We appreciate Kaponda. Yes, they must be identified, but that's not enough. They must be differentiated. Have you seen? Like Mwamba says, identified separately or individually. That is now beautiful. She has narrowed it down to the main point. So we have Mr. Zulu is saying the services should be easily differentiated from what? From others. That is very true. So you guys are awesome. So when we say goods or services must be distinct, we mean what you guys are just saying. Now, why is that important? Now, here's the issue. Let me give you something here. Distinct means customer can benefit from a good or service on its own. Have you seen? And then the promise to give a good or service is separately identified. What do we mean? When you say the customer can benefit from a good or service on its own, what do we mean? Here's what we mean. If Kutemba and I enter into an agreement, Kutemba tells me that she can offer consultant services for me, and I'm supposed to pay 15,000 or 100,000. And then she also tells me, but you know what? I can also do painting of your offices. So we sign contracts. Kutemba is offering consultant services, but also she's painting my office. So we have two different goods and or services. They are separately identified. So for me, I cannot combine the two monies together. No, I have to separate them. I can benefit even if Kutemba pisses me off in terms of maybe painting. I can terminate the contract for painting, but does not affect the contract for consultants. It's different because the contract for consultants is unique. It stands on its own. I'm benefiting from that knowledge independently of other services. That's the difference there. That's the difference. So, but the examiner didn't bring contract, services, and painting. No, the examiner will bring for you a car, a machine, and service, so that you get confused. It's going to tell you that they list this building, or they list this machine. So there's the other components about the list. The other ones about the service. Have you seen? It's like you hire the car from me, but I'm also servicing the car. So now we have two things. You are paying me for using my car, but also you are paying me for servicing the car. Those are two different services. That's what the examiner brings it down. It's down to something very, very close to confuse a weak student. So you have to remember the service part is dealt with under Ifrs number 15. The list part is dealt with under Ifrs number 16. Very important. All right, so there we go, guys. Now, if you can see on your on the screen, guys, there's a statement which says goods or service must be remember the promise to give a good or service is separately identified. So guys, I want to learn from you. What is the meaning of that statement, separately identified? Let's hear your comments, guys. Let's see your comments. Let's see from Facebook and the other guys. What do you think of that? Separately identified. What is that? Well, from talking about distinct looks at the benefit. You can benefit from the good on its own without other promises. How about separate identified? What do you think, guys? So usually students confuse distinct with separately identified. So now I think you're going to see a difference after this one. What do you think, guys? Let me know in the comment. I want to see what you think. What do you think? What do you think, guys? Let me see the comments. I'll give you a few seconds. I'll give you some seconds, guys. Let me see your comments. Let's hear you guys. Yes, guys. Mr. Wycliffe. Let's hear from you. Helen, Mwamba. Let's hear from you. Kaponda, what do you think? Mr. Mlomba, Mwape, what do you think? Mr. Angova Zulu, Albertina, what do you think? Let's hear from you guys. What do you think? Okay, so Daiso says unique in nature from other similar products or services. I think that's fantastic, Daiso. So when we say separately identified, Daiso says unique in nature. How about you other guys? What do you think? Why Mr. Wycliffe, Kaponda, Sema, Mwamba? What do you think? Because I'm such a very nice man, I'm going to tell you. Look at that. Boom. Separately identified means promise can stand on its own without other promises in the contract attached. Have you seen? The promise can stand on its own. Like I was telling you, Kutemba offers consultant services for me, but also paints my office. Those are different promises. They're not the same. The services, consultant services standing on its own. The painting is also standing on its own. Very important to say the difference. All right, guys. So that means number one, goods or service also not modify other goods in the contract. So a good or service should not change other goods in the contract. So goods or services should not be related or should not be highly related. For example, here's what we mean when we say highly related goods. Imagine you enroll for a class like this one because you want to learn financial reporting, advanced financial reporting, and then you're here. Then what do? Revision time comes. I advertise for divisions, but I also charge you, the one who is in class, that you have to pay for divisions. That is not okay. The standard says the service I'm going to offer is highly related to what you've actually paid for. You've paid for a service like this one, where you're supposed to learn advanced financial reporting and financial reporting. But if I charge you again for divisions, that is not fair, because I'm going to be doing the same thing. I'll still be in front of the camera, and I'll be able to talk and give you notes and do questions in the similar fashion as I do in class. So I'm not doing anything different from what I always do. So it's not ethical for me to charge you for a class and for divisions. No, it's not okay, because the service is highly related. Oh yeah. So there we go, guys. So that is number 3. So the other one says that it's extremely important to note those two points. Let's go to step number 3 of the model. Step number 3 says, hey guys, you must be able to determine what is called the transactional price. Now, the transactional price, guys, looks at how much to expect to receive from a client. So in the exam, you have to see, when they tell you they entered into a contract with customers, ask yourself, how much are they expecting to receive from this beautiful client? Now, you have to remember something, guys. When we said how much to expect, sometimes it could be what is called, it is not always that you receive a fixed amount. Can you tell me the different types of payments that you can expect, guys? Give me the comments, guys from Facebook. Please comment, tell me how many forms of payments do you expect to receive from a client in a contract, a normal contract? Let me hear from you guys. Let's participate. How many forms of payments, guys, do you expect? Yes, guys, let's go. How many forms of payment? Yes, guys, let me hear from you. Let's ask you guys to type in. Let me hear from you. How many forms of payment do you expect? Mr. Mulomba, what do you think? Mr. Zulu, Albertina, what do you think? Dadiso, Mwape. Okay, so we have Mr. Wycliffe who says we can expect advance payments. Okay, that is true. There could be advance payments. Helen says cash payment. Helen, fantastic. I think Helen takes down. That is good, cash payments. So anything else, guys? Anything else? Anything else? Now notice we have cash payments. Yes, that is true. But also we have something here. Let me show you something. So we have something here that I would like you to remember. We have this one, and we have any amounts estimated to be received. Any amount estimated, have you seen, to be paid. What that means, it means this. It means that sometimes you can have a variable payment. The payments may change. When we do Ifrs number 16, Lee says, you guys are going to notice that we are going to do what is called variable payments index. We are going to be using the consumer price index, where the prices may be changing every 2 years, every 3 years, or every 4 years, depending on how the markets and the inflation indices are moving. So when we say determine the transactional price, we're not saying the price must always be fixed. No, it is not necessarily what? Not necessarily fixed. Have you seen that? Not necessarily fixed. So it's important that you remember that. So the price is not necessarily fixed. No. Sometimes it could be a fixed payment, or sometimes it could be a variable payment. So any fixed payments also should be expected. Very important. We don't want to rule out fixed payment, but we want to make sure that no, it's not always that the payments are going to be are going to be fixed. Sometimes there will be fixed payments. Sometimes there will be variable payments. So there we go. We can have fixed payments, we can have variable payments, and then we can have other forms of payments. But here's the issue, guys. Sometimes there's what we call royalties, even those ones should be considered. Now, for a royalty, you recognize on when the client uses. If you bake scones and then you come to me, if you bake scones, then I come to you and say, no, what, Kutemba, I love your scones. I love the way they taste. Can I please also be able to make scones? Give me your recipe. You show me how to make. I begin to make. So every time I use your recipe, that's when you're going to recognize the money, because now you're entitled. Even if we agree you're going to be paying me thousands, don't recognize the money if I don't use. You only recognize at the point when I use. That's when you recognize. It's extremely important for you to be able to remember that. Very, very important. All right. Let's go to step number 4. Now, step number 4 is important. What is step number 4, guys? Now, step number 4 becomes important because it says you're supposed to allocate. Have you seen what is called transactional price to what is called difference of cost performance obligations? Why? Who can tell us why we have to allocate this one, guys? Why? But why, guys, are we doing this? Why? Oh, tell us why, guys. Why should we allocate the transactional price? Why? We have a question, guys. Why? Why should we do this? I want to hear from you guys. What do you think? Step number 4 says we have to allocate the transactional price. But why? Why, guys? What do you think? Yes, guys, tell me. What do you think? What do you think, guys? Yes, guys, what do you think? Why should we split? Why should we allocate the transactional price? Why? Let me see some comments. Why? You have a minute, guys, to type something. I want to hear from you. You have a minute, guys. Why? Everybody, guys, I want to see your comments. Why? What do you think? Why? Why, guys? I'm waiting. Waiting for you guys. Waiting for you. Yes, guys. Why? I'm waiting for you guys. Why? Yes, guys. I need to see your comments. Why? Yes, guys. Yes, guys. Mwape, what do you think? Why should we split individual pricing? Why should we allocate transactional price to different performance obligations? Why? What do you think? We have Helen. Helen says, what is Helen saying? Helen says the company needs to know how much each service is worth. Very true. Right? I think that's true, Helen. Yeah, I think that's very true. So the company needs to know how much its service can cost. Very true. I think that's true. And then we have Mwamba. Mwamba says each performance obligation should have its own price in case of contract termination. Very good. I think that's key. You must know, you must allocate the transactional price. In an event that the client is not happy with a particular service, they can terminate one service. That service should not be able to affect the other service. So you have to know clearly the performance obligations. Because sometimes there could be penalties in the event that you breach. And then they say, no, you've breached the contract, we need to pay so and so. So it's important for you to know. Because if you don't know, you end up paying more money than you should have paid. Very important. So the standard gives us guidance. It says, if different performance obligations exist, please split. Have you seen? The standard says split price according to individual pricing. So if you have a contract and in the contract you're supposed to do more than one thing, you're not just spending the office, but you're also offering consultant services. So split the prices. The price for consultancy should be on its own. The price for painting should also be on its own. So in an event that the company terminates the contract, the other part of the contract is not affected. It's important to remember that. Very, very important. So now we have a question there, guys. So how do you estimate? Because here the standard says not, you can even estimate if individual price is not available. So sometimes you can go to the markets. If you go to the markets today and ask how much a laptop is worth, how much a land is worth, they'll tell you, no, 40 by 40, 50 by 50 land, 50 square meters is worth so much. But what do you do in an event that what you have, the individual price is not available? The exam says you can estimate. So the question is, how do you estimate, guys? So I want to learn from you again. Tell me in the comments, guys, how do you estimate the price? It's extremely important to know how to estimate the price. Don't just wake up and say, hey, I'm going to charge 10,000. No, you don't do that. So guys, let me see in the comments, how do you estimate the price? How do you estimate? Mwape, what do you think? I want to hear from you, Mwape. And also, let me hear from Mwape, Mr. Zulu, Mr. Mlomba, Daliso, Kutemba, Albertina. I want to hear from you guys. Helen, Mr. Wycliffe, Sema, I want to hear from you guys. What do you think? How do you estimate? Guys on Facebook, please take a second of your time to share this video. Please give us some support, share the video, and comment. Let me see what you think. How do you estimate the price in an event that there's no individual price available on the market? What do you do? What do you think, guys? You have a minute. What do you think, guys? Yes, guys, what do you think? Yes, guys, how do you estimate the price in an event that there's no available price? What do you do? I want to learn from you. Yes, guys, how do you estimate? Yes, guys, how do you estimate the price? Albertina, what do you think? Your speaker is mute. You may want to unmute, guys, if you want to say something. Mr. Mulomba, what do you think? How do you estimate? Mr. Wycliffe, Musonda, Helen, Daddy, so what do you think? How do you estimate, guys? Yes, guys. So I have a question for you. Albertina, how do you estimate it? Imagine you make a product today as a company, you don't have a specific price. How do you come up with a price? What do you do? Mape, what do you think? You're a manufacturing company, you make a product today and there's no price available. What do you think? Yes, guys? Is it true you guys don't know how to estimate a price? Are you sure? Okay, so Helen says you can use. Okay, good. Okay, we're making some progress. So we have Helen here says market research. That is true, Helen. You can use market research. Sometimes do use the market research approach. All right. Mr. Wycliffe says, okay, you can also by costing it and the markup. Yes, that is true. Get the costs that you have, that you've spent so far when making that product, then add a margin or a markup. That is fantastic, Mr. Eclipse. Thank you so much. Then we have Mwamba. What does Mwamba say? Mwamba says calculate the cost, then add a markup or get the price of similar products. Fantastic. So those are some of the things you can do to come up with a price. That is very true. Thank you so much, guys. That is fantastic. You guys are doing well. Very good. So I'm going to show this one here on the screen. So you use market assessment approach like the guys have suggested. That is number one. You can go to the market. Also, you can do expected cost plus margin. That is number two. You can use the residual approach. Now, this one is restricted. You don't use it in the exam. Forget it. You can also discount if prepaid is significant. Now, discounting, we are going to do discounting more on IS number 37 provisions. We'll discount quite a number of things. Even on listers, we'll be discounting some things. So discounting is going to also work again on group accounts under deferred payments. Also under impairment, IS number 36 will be discounting. We'll be doing value in use, PV of payments, we'll be unwinding the interest. So we're going to get used to this statement. So you can do that in an event that there's no available market price. So Helen Lungu, what does Helen Lungu say? She says also know how much it costs. That is true. Very true. So guys, those are the 4 steps that you must know. Now, let's go to the 5th one. Now, why is the 5th one so important? The 5th step is important because it says, step number 5 says the following. Step number 5 says, recognize revenue. Notice, it says recognize revenue. There's something interesting about this one. When or as entity, let me just share this one. As entity satisfies what is called performance obligation. Why? Why is this important? I have a question for you guys. But why? Step number 5 says this. And my question to you is that why? Look at step number 5. Step 5 says recognize revenue when or as entity satisfies performance obligation. Why? Let's contribute, guys. What do you think? Guys from Facebook, please share the video. Take a second of your time to share this stream. Please just share to different groups, to your friends. Please help us, guys. Help as many people as possible. Please share the video. Please share the video. Just a second. So I have a question for you guys, both in class and on Facebook. Why? Why is this important? Step 5. Why, guys? Why, guys? Why, guys? Tell me, what do you think? What do you think? Why is this step important? What do you think, guys? Yes, guys? What do you think, guys? Give me some comments. We have a minute, guys. I want some comments. I also want to see from you guys. Mr. Zuru, please, let's hear from you. Give me some feedback. I need to know what you are thinking. Mr. Mlomba Shebi, give me some feedback into what you are thinking. Daddy, so give me some feedback. I need to know what you are thinking. Why is this important? Step 5. Recognize revenue when or as entity satisfies performance obligation. Why? Why, guys? Why, guys? Let me hear from you. Comments from Facebook. Let's see, guys. I want to hear from you. Why? Why, guys? Okay, we have a comment from Facebook here. Helen says, because at that point, service or good has been delivered. Okay, fantastic. I think that makes sense. So recognize revenue only when end satisfies performance obligation. And because at that point, a service or good has been delivered. So it means you've now worked for the money. You've now become entitled to this money. So you can now recognize the money. It is yours because you've worked for it. This is what Mwamba Seba is saying. She's saying, in case you fail to satisfy the performance obligation and you don't earn anything, so you can't recognize in advance. Have you seen? So you can't, if I pay you in advance for the service not yet delivered, you can't recognize the money. What if you fail to deliver? Then I sue you. So don't recognize. I think that's a very good point there, Mwamba. Thank you so much for participation. Thank you so much. You guys are doing awesome. Helen, Mwamba, Mr. Wycliffe, you guys are doing very, very much fantastic. Thank you so much. Okay, that's good. Okay. So let's look at something else again, guys. Look at this one. Now, there's something else about this. So when we say performance obligation, we mean something like this. If it has been satisfied, we mean that, hey guys, please only recognize revenue. Have you seen that? When control occurs. What do we mean by that? When control occurs, either now or in the future. So when does control pass, guys? That's another question. What is control? That is, what is control? We are being taught recognize the revenue when control passes. So what is control? Yes, guys. What is control? Yes, guys. Tell me. So please unmute your speaker. It's a question. What do you think is control in this statement? Mwape, what do you think? Guys, what do you think? It's a question. Mr. Zul, can you hear me?
Yes, I can.
Hello?
Hi, I can hear you.
Give me some feedback, guys. You can hear me. I'm asking a question. Give me some feedback. Okay, so this says when the expected specs have been met. All right, okay. Anybody else, guys, what do you think? You can just say it. If you're in class, you can just say it. Even if you don't type, it's okay. Mr. Zuru, what do you think? Control, guys, is simply the ability to direct use of asset and enjoy all benefits. That is control. So control is simply ability, just ability to direct. Have you seen that? Direct use of what? Use of assets and enjoy all benefits. Very important. So that is control. Ability to what? Direct use of assets and enjoy all benefits. That is control. Yeah. Okay, good. So we have we have Helen says when you have a right, and we have right to use an asset. That is very true. That is control. So we have a comment in the private box from Map. I think this is when the customer has full responsibility, benefits of the goods or services. That is very true. that is control has passed. So only recognize when control passes. All right. So in the exam, they will tell you, the examiner will tell you, no, control passed and things like that. Now, when control passes, you're supposed to remember, okay, if control passes, now remember, control passes, that means you are going to enjoy all the benefits, but also all the risks. Have you seen? So all risks also. It's not just about the benefits. This may include even the risks. So even the risks also you're going to bear them. So while you're enjoying the benefits, you're also enjoying this. So the question that we have is, what about benefits? What kind of benefits are these? Benefits? What are these? What benefits can you enjoy from an asset? I have a question for you guys. What do you think? What benefits can you enjoy from an asset, guys? If I lease my car to you, what benefits can you enjoy apart from driving it? What do you think, guys? Yes, yes. I can't hear that. Let's hear from our Bettina. But what do you think? If I lease my car to you, what benefits can you enjoy apart from driving it? Yes, Bettina. I don't think I can hear that. Guys, unmute your speaker if you want to say something, please. I can't hear anything.
Hello?
Bettina, I can't hear anything you're saying. Yes, yes.
Yes. Sorry. I'm moving. I'm just reaching home.
All right.
Okay. So apart from driving it, I can enjoy other benefits. For instance, if you lease me a car, the convenience,
Yes.
then I would also maybe perhaps save on time.
Oh, yeah. All right. Okay, that is true. Guys from Facebook, what do you think? What other benefits can you use? If I lease my car to you, what other benefits can you get apart from driving it? I like what Victoria Panama said. Victoria, you are just awesome. I think I should buy for your lunch. See, she says it can be used as surety or security in the event you want to obtain a loan. Very true. So some benefits are indirect, other benefits are direct. So Victoria, you've just nailed it. So think about that in the exam. We have another comment coming through from Mike who says recognition. Okay, it can also enhance the value of other assets. You understand? You can also use it like she said, collateral. You can use it to enhance the value of other assets, and also you can also sublease to someone else. So you can sublease the asset from someone else. So those are the benefits. All right. Okay, you can use the asset, the holding asset. Very, very, very important. So these are some of the things that you must remember, guys. So remember, when control passes, risks also pass. Apart from risks, you also the rewards also pass. Have you seen that? Yeah. So now remember, revenue recognition. We only recognize revenue when control passes. That means all the risks and rewards have been transferred from buyer to seller. Very, very important. All right. So guys, there's something else I'd like you to look at. You must remember that the standard Ifrs number 15 applies to all contracts except to leases. This standard does not deal with leases. So if you're in the exam, you're dealing with a question that deals with a lease. The lease component must be dealt with under a lease, and then the other component must be dealt with under Ifrs number 15. It also does not apply to insurance contracts, does not apply to financial instruments, That's the thing. Now, the example I can give you in the example can tell that company so and so went to the bank, they got a loan, they got a mortgage, they got a mortgage, but also the bank also offering this company some other services. So remember, a mortgage is a financial instrument. You can't deal with a mortgage under IFRS number 15. But the other service can be dealt with under IFRS number 15. So you have to see in the exam. If the examiner says something that that's not dealt with under IFRS number 15, use that other standard. If it's a lease, use a lease. If it's a mortgage, use financial instruments. IFRS number 9, very important. Yeah. So there are some words I would like you to know, guys. I want to give you some assignment. I want you to tell me the following statements. I want you to be able to tell me number one. I want you guys to be able to tell me some key terms. Tell me what is a contract. I want you to tell me what a contract is. That is number one. So I need to know you to tell me what a contract is. This is very straightforward. I want you to tell me the difference. Tell me the difference between revenue and income. Do you know even accountants don't know what this is? Difference between revenue and income. If I ask you right now, what is revenue? You won't tell me. Guys, what is revenue? So tell me the difference between revenue and income. I'd like to hear from you what the difference is, revenue and income. I want you guys to tell me the difference between revenue and, of course, income. So tell me the difference between those two, revenue and income. That will be very, very nice. Also, you tell me the meaning of what is called performance obligation and transactional price. So you also tell me performance obligation, what it means. You tell me what that statement means. And also you tell me transactional price. So the next time we're going to meet, we are going to do a calculation. We are going to enter into details, and then we are going to talk about how to recognize monies in your books. If a client pays in advance, or if a client doesn't pay in advance, and things like that. So you must tell me those kind of things. Performance obligations, revenue price, and also tell me the difference, of course, between revenue and income. Extremely important. So guys, it's been nice, to be honest, to be with you tonight. Remember, if you want to enroll for this class, we're just starting today for March 2022 and June 2022 exams. You can call the number that is scrolling on your screen so that you can be part of this class, so that you can benefit more from assignments, you can benefit more from seeing the digital board and things like that. So we will not always be using this platform. So please, if you want to benefit, enroll with us. You can call 0953 979798 or simply email us at the private tutor so45@gmail.com. Or you can either just simply send the inbox message private to SL on Facebook. You can find us on YouTube. Please go to our YouTube channel, subscribe. There are lots of videos that we're going to be posting, so don't miss out. Please go there and subscribe. You'll be happy to subscribe from there. So guys, it's been awesome to be with you tonight. It's bye-bye from me. Thank you so much for being here. I'm gonna see you on Wednesday, 19 hours. Bye-bye.